9-week moving average, we have a bearish trend momentum. With the market closing above the weekly mean or average price of 1783, it indicates a bullish price momentum. We have a mixed signal with a bigger trend bearish, but the momentum within that trend is bullish. If it closes below 1783, it will negate the bullishness to neutral. If you are short, 1771 and 1756 are levels to cover your shorts and reverse and go long. The long signals tell you to take profits if you are long at 1795 to 1807. The VCPMI gives you the extremes above and below the average price at which to cover shorts and go long, or get out of longs and go short. Silver.
Testing 1, 2.
The weekly trend momentum of 23.79 is bearish. The price closing below the trend momentum activated a bearish sentiment. The weekly VCPMI or average price of 22.22 is bearish. If you are short, take profits at 21.81 to 21.40, which were met. It then activated a buy trigger at 21.81 with a target of 22.63 to 23.84. Bitcoin. Bitcoin weekly trend momentum is 58,246, which had a bearish sentiment. Since the market was below that level, the weekly VCPMI or average price is 49,100, which is also bearish. The market closing below it. A close above that level will negate the bearishness to neutral. If you are short, take profits at 46,005 to 44,120. If long, take profits at 50.98 and 54,080. If activated, the target of 46,722. It does not guarantee that the market will come down that much. The VCPMI gives probabilities, not certainties. We are at an extreme below the mean. The market is most likely to revert back to the mean from the extreme levels. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca. I wanted to share that report that we published in Mean Reversion Trading in Seeking Alpha. Let's move right into the market here. Gold trading, silver trading last at 21.96. It's activated a buy trigger from the buy one level here. We recommended our traders in our private trading room to go long. If you are long, trail the position with a stop. Let's just take a look and watch the market here for a little bit. We seem to be getting a lot of volatility to the upside as the unemployment numbers came out this morning at 9.6%. Producer price index, the biggest number in 40 years. And the gold market is a little bit of delayed. Actually, it was down quite a bit here this morning earlier, and we're beginning to see a little bit of a correction taking place. It is, I would say, more than abnormal for the gold market to be down here at these levels, particularly in the face of inflation levels that are going back to 1980s when interest rates were at, I think at the high was about 19%. We have pretty much the grains as well. reverting to the upside. I happen to think that we're looking at a buy or sell the rumor actually and buy the fact in the metals, or if we take a look on some of these other assets here are beginning to react. I think the fact that the gold market is down is a complete anomaly, and it's a buying opportunity, as we recommended our traders to take advantage of this move here early this morning. The pattern of 1777 was completed on the gold market. This is the first signal that basically was completed. The weekly target is 1783, and we have activated actually a weekly signal in gold, as you can see here. So I think what the VCPMI has identified here is pretty much the extreme levels of these markets. We're getting a pretty big move here in grains, and it looks like we potentially could be taking out these 372 previous high, and it puts into the target zone of 408, which is the 161.8% golden ratio extension, Fibonacci extension targets for this move if we break out, and all indications are pointing to that possibility happening. The economic numbers that are coming out regarding the CPI last week at 6.8%, the PPI this morning 9.6%, are not transitory. And I think the initial reaction of the market here this morning was that obviously it puts pressure on the Feds to raise interest rates sooner than later. I'm not so sure that it's going to be easy to do here, since we're dealing with a different dynamic than we had back in the 70s with regards to the debt. The debt back in the 70s was below, I think it was about $800 billion, 900, below $1 trillion. And interest rates were at, 19% on a high, I think it traded. And so there's a long way from 19% down to negative 4.5%, which is where we are right now. So this is the dilemma that we're finding the economy with negative interest rates. The 10-year note is at about 150, and you have the CPI at 6.8, and you have the PPI at 9.6. I think you can do the basic math and find out that we're at negative 4 or 5% real nominal interest rates. And so this is a truly different dynamic than we had in the 70s. And so when we take a look at the a 10-year note, it's trading at 146, 146.70, up only four basis points. It is not reacting to this inflation fear that we seem to be getting into the market based upon these indicators that are showing record levels on the CPI and obviously record levels on the PPI. So um, the market is dealing with an anomaly, obviously, in trying to dissect what it is the market wants to do. Let me share with you here what I'm doing personally and what I am recommending to my traders in my live trading room here. Number one, I've been uh, surprised of where things have gotten in such extremes, particularly when you take a look at inflation running at these levels here, and you take a look at gold down about 6-7% for the year, and silver down about 13-14% for the year, against these levels of inflation that are at 40-year levels. Doesn't make any sense. And as long as I've been around, and I think when we talk about the metals markets, metals have been around for thousands of years against, you might say, in a monetary system that it is in the process of being readjusted to these levels of inflation. And I believe this acceleration of inflation that we have seen has been caused primarily by the Feds, by the tremendous amount of the explosion in the M2, the money supply, which I believe is at around $5 trillion. It's record levels. So there is a lot of money in the system. And that is what's causing this price inflation that we are seeing year to year as a consequence, initially of the pandemic, going into a lockdown, collapsing consumption, creating a supply shortage problem, and of course coming back into some kind of a normal economy, finding ourselves with the fact that we have less supplies than anticipated because companies didn't store prior to or in anticipation of the pandemic, and with this record demand that seems to be coming into the market now, we're finding that demand is way above supplies, into a bottleneck of supplies. So the question really is this inflation that we're seeing real? Has it integrated into the economic system? Because if it has, and it is not transitory, then the Feds are in a dilemma, the markets are in a dilemma, and the talk is going to be about tapering and about raising interest rates. If you noticed, nothing has been done with regards to inflation by the Feds in the last few meetings since June. All the Feds have done is basically talk the market down. But there has not been any actual monetary policy change. And we have seen the commodity markets, we have seen the digital markets, pretty much the metals markets across the board come down to these extreme levels below their mean. And so it potentially could be building up a sell the rumor about rising interest rates or tapering, and the fact, when the fact comes out on tomorrow's meeting by the Feds, the markets could have a reverse reaction to the expectation. It might be that the market's already discounted tapering. It might be that this is the anomaly, why we are not seeing the reaction yet in gold or in the metals or in the areas, you might say, that were affected by the policies that you might say began its talk back in June about tapering. All they've been doing is talking about tapering. In the next meeting here, we're going to see if the tapering is going to be accelerated, and whether the Feds think that this is cause, you might say these indicators that came out are cause for them to talk about raising interest rates sooner. So it's putting an uncertainty into the market. Obviously, in the equity markets, the E-mini is down 30 points. We've activated a short trigger from, or we are activating, you might say this whole week, short triggers from this level of 46.87. And obviously you can see the market activated a short trigger on November 26, and it completed the pattern here on December the 2nd. It rallied up into that level once again, and it seems to be completing the trigger from this level of the sell one level. Now, if we come down below 46.32, we're going to be activating a bearish price momentum, and the lower targets below of 45.24 to 44.69 will be activated. We're trading at 46.2550. So we're turning bearish into the equity markets, and it could be that we're making some kind of a double top. Bitcoin, interesting enough, I want to point out to you that the chart in Bitcoin looks very much like the chart in the gold market. Incredible similarity. And so this is the first time that I'm beginning to observe the relationship of gold to Bitcoin, or the spread relationship narrowing, you might say. And that's an interesting development that's taken place. And we're going to continue to watch this very closely here. And from where the market is right now, it looks like gold is in again a blue level, which indicates accumulation of supply. Where you build a position if you are looking to add or do multiple positions. In Bitcoin, pretty much in the same level, and it activated a buy signal, a buy trigger from the weekly by one level of 46,005. So we are trading at extremes below the mean on gold and Bitcoin. The silver market is in the same situation, and you can see the silver chart also is mirroring Bitcoin. It usually follows, obviously, the gold market, and we're looking at almost the same pattern building on all of these three assets that are indicating they are at the extreme level below the mean into an area that is in accumulation of supply, that is indicating that this is where you want to accumulate your inventory. Just to recap, I believe that the anomaly in the gold and digital markets are going to be adjusted here as we see more clearly what the Feds are going to do regarding the monetary policy as we end this year and also into 2022 or 2023. The inflationary economic indicators seem to indicate we're running inflation hotter than expected, mirroring the 1980s. Again, the difference is that interest rates were at 19% roughly on the high during that time, and gold was at $850. And the Dow Jones was trading at about $1,000 at the time, very almost at par with the gold market. Obviously, you see where the stock market has gone. And interest rates are at a negative rate, roughly running at about minus 5% or greater. And this is coming into a debt. This is a debt level that is approaching $30 trillion, not including unfunded liabilities like Social Security and so on. Again, this level of debt is unprecedented, and if interest rates do go up aggressively, it puts at risk tremendously the world economy, and it puts at risk the debt level of being defaulted in some way. I believe that governments, this is a global problem that we have, are going to find a way to hedge against this tremendous debt bubble that we have by allowing inflation to run at higher levels than expected. It is the only way that they can monetize the debt is by deflating the currency. The debt is it. Again, very much like Mexico did back in 1981 when they defaulted on the U.S. debt. And the peso went to hyperinflation.